Hello and welcome back to the ROI podcast, the podcast that's obsessed with the art and science of return on investment. Favorite guest of the channel back on today, it's Mr. Josh Young, CIO of Bison Interests. Disclaimer, guys, nothing that we say here today is to be construed as advice. It's two guys having a very long distance chat, and we're going to see where it takes us. We're going to talk about the oil market. We're going to get an update from Josh's perspective. We're going to talk about a piece of news that could be interesting, when the CAPEX is going to flow, and then our favorite AI company, of course, Vital Energy. It's not NVIDIA, guys. It's not NVIDIA. It is, in fact, Vital Energy, and we'll talk about the controversies around that. If you enjoy the content, please do like and subscribe. It makes a tremendous difference to the algorithms. 50% of the content viewed on this channel is viewed by non-subscribers. It's completely free. So if I've given you any piece of value today, guys, just hit the like button and subscribe. Would greatly appreciate it. Josh, welcome back to the channel. It's always fun talking to you. How are things with you?
Things are good. We were chatting just offline. It's sort of one of these moments where occasionally, everything goes right for companies or sectors, and prices go the other way. So, done this long enough that I've experienced a number of these, and it's a good time to catch up and chat about it.
Absolutely. And it's so interesting. It's an emotional intelligence aspect now, as opposed to, let's say, the cerebral. And the logic is telling us one thing, and then it's always funny how we get those gut checks. I'd like to start with a tweet that you retweeted. It's a tweet of Eric Nuttall's talking about how the energy sector, at least in Canada, has been one of the top performing sub indices, and yet it's receiving no money flows. People are completely ignoring it. What's sentiment like from where you are, and how do you view the current sentiment versus the reality?
Yeah, so we've seen this from a number of different sources. I think that was from originally from Goldman or JP Morgan. I can't remember exactly which sort of what the original source of that particular analysis was, but you see it from a number of different places quantitatively, as well as seeing it at conferences and just networking events here in Houston and various other things. There's really no, when I started investing in publicly traded oil and gas companies professionally in 2007 for a multi-billion-dollar family office, there were hundreds of investment firms dedicated to oil and gas public equities, or funds within larger firms dedicated to oil and gas public equities, or portfolio managers who ran large portfolios focused on publicly traded oil and gas equities. And today, outside of the sort of pod shops that run sort of zero net exposure and have very little sort of net effect on valuation or aggregate effect on valuation, there's almost no one left doing this. There's maybe half a dozen or so firms focused on this, or funds really focused on publicly traded oil and gas. In many cases, I'll go to conferences for oil and gas. So I didn't go to CERAWeek, Week, which is sort of this weird amalgamation of reporters, and it's sort of like the barbell of the energy industry, like folks like totally uninvolved and like looking to throw stones, and then the senior most executives like having conversations that are sort of detached from the realities of their businesses. So I didn't go to that one. I'm sure it would have been even more extreme, but you go to the XYZ private capital conference, you go to these deal-making conferences and so on, and people forget, even people that work for large publicly traded oil and gas companies, they forget that there's a business of investing in energy, and they don't even think about it. And when they do, it's 100% thinking about the private equity aspect, going and backing private oil companies and growing them and then reselling them. And so there's this missing part of the value chain. And so you see it in a lot of different ways. And there's, I think, a great opportunity because it's just so hated, and so like, I mean, it's almost not even hated anymore. There's just nothing there, which you see in one way through energy flows, where I don't know if that chart was actually 100% accurate from that particular bank, because what's happening is you're seeing fund flows into equity ETFs like the S&P 500 ETFs or indexes. You're seeing it a total market. And so you'll end up actually with money going in, but only in the proportionate exposure to the market. And so anyway, it's a crazy situation, but you're having this really wide discrepancy and dispersion in valuations across names in the US and Canada and elsewhere. And again, it's like one of the most promising and exciting times ever to be a stock picker in oil and gas equities, but also the most frustrating because there's still money actually stampeding to the exits among people that still remember that this thing even exists.
Yeah, that's so crazy, especially given that you're based in Houston, Texas, which is like I won't say the mecca of oil because we do have the actual mecca with Saudi Arabia, but you know what I mean in terms of capital provision for the sector. That has been such an important place globally. With it, oil being just such an inelastic commodity in terms of its demand. I mean, we cannot do without it. Where do you see this thing in terms of eventually we are going to need um, more investment into this space? And you mentioned that public markets aren't really performing their function in terms of providing that extra opportunity for liquidity for these companies. How far are we away from, say, the narrative hitting the hard landing of reality?
Well, so that's part of the craziness of it. So, again, like you said, with the disclaimer, this isn't an offer, recommendation, solicitation, anything like that. But Bison was the top performing equity investment firm globally in 2021, right? We were up almost 400% gross, 300 something percent net. It's like the Big Short from, let's say, Q4 2020 to Q2 2022. We're up almost 1,000% gross. Maybe it was more than that. Whatever, just like stupid numbers relative to a market that was up, I don't know, 20% or something like that. And the energy market that was up, let's say, 150%. So crazy. And like no one even wanted to talk about it. Like we have this like Barron's thing and they didn't want to talk about it. The Wall Street Journal, they've like all lost my number. Bloomberg hates me because I'll talk about how they run a consulting business on the side that they advertise through their news media. So they like actively dislike me. So it's crazy. It'd be like if The Big Short happened, but like it's 2009 and no one even
Maybe
knows and
ignored
no
it.
one talks about it. So I don't know. I don't even know where to begin with that, except that, hey, if imagine you earned those returns, but the housing market bubble was still going on in 2009. You just go buy all the same stuff over again. And, maybe you're down 10 or 20 or whatever percent from the top, but like with crazy dispersion where some stocks are up huge and you're able to sell those and whatever. And then others are down on either, fundamentals. In some cases, you can be wrong or have things that go bad, or, on just people not liking them or the stocks not going up, and therefore there being no momentum effect and no reason for the very small amount of dollars looking to deploy going into stuff. But it's just the craziest time, and just so promising as a value investor and so odd in terms of historically how capital has chased returns and people are just asleep. I mean, I don't know. It's like, I don't think this is going away. And I think the thesis is proving out. And so that gets back to your specific question, which is if you look at cocoa and you look at what people were saying about cocoa a few years ago, and we follow it, it just, there haven't really been great public equities to get exposure to it. And we are focused primarily on oil and gas producers, and they were very cheap at that time too. But cocoa is up, what, like 20x or something from its 2020 price. And it's going vertical right now. And you have all these people that were saying, oh, hey, it can't go up that much more. And from the XYZ analysts at big media companies to reporters to whatever, everyone said, oh, it's big and it's a big move, but it's done. Or they made analogies to various other commodities that spiked. And I don't know where cocoa ends, right? I don't know how far up it goes, and I'm not an expert in the cocoa market, but I think it's helpful to look at that. There are these sort of frictions in commodity markets where you can end up in an undersupplied situation. And when you start to explore demand destruction, like the degree to which you need people to change their habits to potentially stop consuming enough chocolate to drive the price of cocoa down, I don't know. I mean, it's going to be crazy. And the reality is that most consumption of oil is pretty similar. And so, I have these $250 WTI oil hats that my buddy, his research firm put together. And I thought it was fun. It was a little scary because you don't want to jinx it. But honestly, like there's nothing that keeps oil over this cycle from going up in the way that cocoa has gone up. And if anything, it could be more extreme because people can live with eating a little less chocolate, but in many cases, they can't actually consume any less oil. A lot of the oil consumption is actually non-discretionary, whereas cocoa consumption is almost entirely discretionary.
My girlfriend will beg to differ, but that's another story. Just she would sell her car in order to buy more chocolate. I have zero doubt about that. That's the scary part. So you mentioned 250 WTI as, kind of a joke. However, let's explore that. Since last year, you were mentioning factors like Chinese demand, Iranian crude. Let's just say there are some ships that were carrying heavier loads that are now carrying slightly lighter loads. Shale supply surprising on the upside. Those were factors that, kind of had a pretty ho-hum end to Q4 last year. However, where do you see the supply demand situation today? And with this idea of a blow off top, oil does have a very large financial or paper market. What's the capacity of that to continue to beat this thing down in the face of let's say, a physical tightening of the market?
Yeah, I think this is sort of the big open question across a number of commodities, and it's why looking at what's happening with cocoa is so interesting. The sort of issue of failure to deliver has been a problem for commodities historically in tight scenarios and frankly in ultra loose scenarios. So like for oil in 2020 where prices actually went negative for a day. And again, like what does that actually mean for the price of a commodity to go negative? Obviously, people would accept an infinite amount of a commodity that has a real productive use and get paid to accept it. But there's logistics around receiving it and delivery specifics on contracts. And so I think in the same way as you saw prices go irrationally low with commodities in 2020, you could see prices go irrationally high. So we've already seen this. I think it was with nickel a couple of years ago, where there was a failure to deliver on the London Metals Exchange. I may get that name slightly off. People got so mad. I like tried to not publicly comment on that, but that was crazy. Some of the hedge funds that were active in that, and they're active on Twitter and other places, and they were so mad, and there are big lawsuits I think happening now. So you saw nickel just go crazy. Like it went up 10 times more or something that it was
Before they
supposed to.
stopped, halted trading. Yeah.
What's that?
Before they halted the trading, like they actually
Yeah,
just,
then
that's
they
it. We changed
halted
the rules.
trading and yeah, and canceled trades and did all kinds of weird stuff they're not supposed to do. And so we're seeing this again now with cocoa. We saw olive oil pricing went sort of crazy too. So I think we're seeing it on some of these sort of smaller commodities. We've seen it on natural gas actually in both directions. We saw crazy price moves up in natural gas a couple years ago, and then weirdly timed physical issues with export facilities, and then to this down move where you have really irrational capital allocation by drillers who are unhedged or only moderately hedged, where they're spending incremental money to drill to produce gas, but like at half their stated break evens. So you see really weird stuff happening, and there's lots of sort of these bounds, I think I would say, on how commodities have been allowed to move from a price perspective. And I think it's exciting if you're a price optimist and if you're a price pessimist, because it just means you're going to have more volatility and that you might end up seeing prices that are radically higher than what's acceptable to say on a podcast or in a flight conversation or so on.
Yeah, it does stoke the imagination, certainly. Previously, you've written in articles that I've read, and I strongly suggest people to subscribe to your Substack. The link will be in the description. That given some of the supply demand scenarios, you see potential for a 2 billion barrel deficit. Is that still on the cards? It didn't play out Q4 for factors that we mentioned. Is it possible over the next 1 to 2 years? And if you were to put your speculator hat on, what might that mean for a price scenario?
Yeah, so I think it's been really hard to get the oil market, the current state of the oil market wrong. I see these very, very expensive data provider and analytic services get it wrong by a lot all the time. And so I'm trying to step back from that, just seeing, I don't want to name them, but there's a number of services and they're almost all consistently wrong, just in different directions at different times. And then there's investment banks that subscribe to all of them and are also wrong almost all of the time. And I don't really actually need to make calls on any of that, I think, over time to do well as a equity investor in the space. So I think I've been trying to step back a little from that, but I don't think anyone knows, frankly. So there was just this headline, Goldman has US shale production down 400,000 barrels a day from the ostensible peak in, it looked like October or November of last year. From, I think supposedly we were at 13.3 or 13.4 million barrels a day in the US, and now we're at 12.9 or something, according, I think that was their number. The EIA had different numbers and they keep revising them. So the government doesn't know, and they have to revise it repeatedly. And then, Goldman was using Genscape, I think, for that. They don't know. Rystad doesn't know. I don't want to keep going down that list, but there's a whole, everyone doesn't know, and they keep revising it in both directions. So I think a lot of humility is necessary, and I think it's necessary to really look at the broader trend and say, okay, like, what is it that's actually happening? And so last year was really tough because there were numbers that didn't make sense that were showing up from shale producers. And it turns out that they might have actually not been producing as much as people were saying they were producing. And so when you dissect what it actually means for Genscape and Rystad and whatever to be wrong on current production, and the EIA to be wrong on current production, again, I don't think they were making up the numbers. I'm not alleging malice. I just think it's very, very difficult. And I think a lot of the indicators that people were looking at and looking for weren't as reliable as they thought. And so a lot of oil bulls last year, I think, got shaken out of their thesis because they saw an improvement in capital efficiency that was radical relative to expectations. You had rigs falling and production rising. And so the joke was, oh, it's magic production, right? And so there were allegations of fraud or manipulation by the EIA. There were changes in their process. So there were some aspects that were not, I would say, totally innocent, but they also weren't, I don't think they had their finger on the scale. They just publicly changed the process in a way that showed more production, which is fine. They just, you just have to, I think, backdate that process to understand sort of where we were and then where we are and where we're going. But the big thing is, I think, understanding what the long-term sort of story of underinvestment and declining oil exploration success and activity and declining delineation and sort of proving up of new fields, and then failure of OPEC plus to actually hit their quotas when they raised their quotas, and then the inability of certain OPEC countries that are considered to have a lot of spare capacity to actually deliver their full quota amount at times when they ostensibly had that spare capacity to do it. When you take all that together, I think you can get to a view that where it doesn't necessarily matter, are we 900,000 barrels a day undersupplied? Like, I think Bloomberg just reported that some group said, okay, cool, maybe we're 900,000 barrels a day undersupplied right now. Maybe we're 500,000 barrels a day undersupplied. Maybe we're 1 million barrels a day. I'm not sure, but I know what the demand trajectory is, which is that we're growing demand globally by, let's say, 1 to 2% annually, maybe even a little more. And I know from a supply perspective, we are not growing supply by that rate. So it almost sort of doesn't matter. And I feel like there's a real risk in getting stuck in the weeds and worrying so much about, is the per lateral foot well productivity going to be, per, let's say, 1,000 feet? Are you going to get 80 barrels a day in the first month or 75? It sort of doesn't matter. It just matters that you're not going from 80 to 200. And that you're eventually going to go from 80 to 70 to 60. And then it matters how many rigs there are and what the trajectory is of the rig count and so on. So again, I know it's sort of like a big answer to a little question, but I think when you think about, like, what are you trying to accomplish when you analyze these sorts of things, I think it makes sense to accept a large degree of personal humility as well as sort of firm humility, and then look at who the best investors are in the space, look at who the best analysts are and data providers. And the reality is that no one knows. And so if you're in a game where no one knows, maybe it's better to not try to play that game. Maybe there's other games to play that are better, like undervalued equities and other things where there's just a much higher hit rate and a higher payoff than betting on short-term oil trends or oil prices.
Indeed, I think there's a lot of misplaced precision being applied, and it is. We're all a little guilty of getting sucked into that intellectual game, and the macro is very seductive in that aspect. Luckily for me, I'm not smart enough to play that game, so I look for things that are much easier to grasp, such as rig count, for instance. That seems to be a pretty clear leading factor to some of the supply dynamics. Where are we in terms of rig count for oil? This is the last question before we move on into the more granular stuff. For some reason, rig count seems to be increasing while the price is low, and oil price seems to be, reasonably good, and yet the rig count doesn't seem to be following. Where are we in terms of rig count, and what has traditionally been the lag time between a reduction in rigs and a movement in the oil price?
So the price of oil has disconnected from the rig count pretty substantially since COVID. And so it's one of the things I think that should make one more bullish oil relative to however bullish you were before, seeing that particular disconnect. And what's happened is that there's been a change, apparently not among gas producers, where there's been higher rig activity relative to gas price, even looking at 6-month out price or so on. Again, I think there's weird things going on there that I think merit significant investigation, and I think there are real principal agent problems among a number of different actors in that space. And I guess I'll just leave it there. But on the oil side, there's a disconnect the other way, where you see way fewer rigs and relative to the price of oil, and so it's less about a lag and more about historically there was a very, very tight correlation, and it disconnected. And so the answer by oil bears last year was, oh hey, you can grow a lot by drilling with fewer rigs. And the odd part about that was when I talked to the producers, they said, no, that's not true. When I talked to the services companies, they said it's not true. When I talked to the midstream guys, they were like, where are the volumes? We see this in these reports, but like we're not getting, we're getting gas, but where's the oil? Frankly, where are the NGLs? We're not seeing what we're supposed to see. Talk to the royalty guys, they're mad. They say, like these reports say we should be getting more barrels. Are these producers lying to us? What's going on? So the oil bears and the EIA and then a few of these analytics groups versus the whole industry was a very, very odd situation. And it turns out that the boots on the ground approach won. And that lower rig count, a lot of it was drilled uncompleted well completion, where they were just using wells that had already been drilled pre-COVID. And then that there wasn't actually as much production growth as people thought. And so there was a productivity improvement in, I think the last big one was sort of in 2018, and it took a few years to filter through because of the dislocation during COVID. So there was a productivity improvement, and we've sort of already gone through it. And now we're at a point where well productivity is actually starting to fall off again, with accelerated declines. And so I think what we're going to see is either, let's say, another 100 more rigs running in the US by the end of this year, or we're going to see substantially lower oil and NGL production in the US. So I think that's sort of when it comes down to, when you look at the well productivity, you look at where specifically they're drilling, what they're getting, and then what the trends are in those areas, you really need more rigs. The companies will tell you this too. In many cases, they say, oh, well, that's the trend, but we're doing a little better. When you factor in all the little betters, you still need another 100 rigs to sort of have these companies hit their targets. And there's lots of things that people have talked about a lot in terms of, private producers trying to grow production ahead of selling their companies, and then public companies going and buying them and allowing that production to sort of roll off. That's been happening for some time. So I don't know how different last year was from 2 years ago. There's an aspect of private producers that weren't looking to sell, just accelerating production into higher prices in 2022. There's an aspect of production just going up when prices were higher, where it made sense to go work over wells and do other things, like any plumbing type activities you could do when prices were over 100, you'd do, especially because people deferred that sort of maintenance when prices were at 10 or 20 or whatever dollars a barrel. So there were a lot of like one-time gains too. And so I think when you look at it in aggregate, I think you need a lot more rigs to run to hit the numbers that people were expecting, which were already pretty anemic. And every day that there aren't, let's say, at least another 50 rigs running, you're going to see this sort of cumulative production disappointment in shale. And as you're seeing it, you're seeing the narratives from a lot of the investment banks and research firms and so on shift incrementally more bullish. I mean, it's not an accident. You're sort of seeing that week by week. You see some of the big, well-known banks that were pretty bearish in December. I've joked about this, how I did this Bloomberg interview in January, it was CNBC, and I was the only person they had talked to who was bullish oil. They had talked to, CEOs of big oil companies and analysts. Yeah, it was crazy. Like, they're literally, I have this like screenshot, like their website. It's not my opinion. It was like 8 other people and me, and they like looked confused. They couldn't even understand what I was saying. And many of those people, not all of them, but let's say 4 out of those 8 are now neutral or bullish. And so it's not an accident. That's happening because people are starting to see production get revised down, and they're also starting to see some of this big issue. Again, it's not about, hey, is there a 800,000 barrel a day deficit right now, or 600,000 or a million? It's about, where are we on this path? Is there material underinvestment? And then is there demand growth? And are we on a trajectory for more undersupply or less? And I think it's becoming increasingly clear to anyone that's spending the time to look at it that it's more, not less, that there's more of a need. And then many of these theories around, let's say, I think the 2 big ones in the last few months were, OPEC is fighting and therefore there's going to be the market flooding. And we've seen sort of the opposite of that, other than the 2 smallest members of the smallest members who couldn't meet their quotas anyway. I mean, they were like 300,000 or 400,000 barrels a day below their quotas, and they're like fighting with OPEC. And, oh, we're going to leave. It's like, okay, cool. So maybe it's unclear what that means production-wise, but it's certainly not negative for the oil market. And then this other one on, you can turn natural gas liquids into refined products, which has always been sort of true, right? Like, NGLs are an outcome from the refining process, and you've always been able to recycle them back in through the refining process. This is just a normal part. There were issues a year or 2 ago about certain aspects of those, or certain of the refined products that were turning into a glut, and actually some of those are now in a deficit in Asia, and so the tankers that take them, or their day rates are ultra high, and then others where you can take certain NGLs, and if you refine them really carefully, you can get, I think there's one plant that turned on that's producing 30,000 barrels a day of alkylate, which you can use as a part of your gasoline process to get higher octane gas. But even that's sort of exciting. That was like this supposedly huge thing. Oh, therefore there isn't peak cheap oil and there isn't whatever. And the reality is that using higher octane gas just means it destroys your fuel efficiency. You just burn more of it. So
it's paradox.
So anyway, so it's just really interesting. I know we want to talk about specific companies, but it's just been, I think it's so easy to see the noise and these different narratives, and it's so important. I mean, we named the firm Bison. The idea is that there's a storm, there's all kinds of cross currents and all kinds of opacity, and it really just helps to be able to look at what you're trying to accomplish through, let's say, owning oil and gas stocks, is to own commodities in commodity producers in a sector where this base thesis that we've had since 2015 is that there would be material, and that there was material global underinvestment, and that would eventually translate to much higher oil prices and much higher valuations for the businesses that we're investing in. And so, I think, like, when you zoom way back, and again, it helps to like understand these different things, because you don't want to miss the next shale boom and have an overwhelming glut of production from somewhere and have prices crash and lose all your money. You don't want that. But so you want to track it closely, but you also, I think, don't want to get lost in the storm. You don't want to get sucked into the noise. And I think it's really hard. We're all people. We get carried away by our emotions. And there's this very powerful tendency for narrative to get driven by price. And it's important to just do your own work and be able to figure these things out, and to keep an eye on what actually matters, to be able to look through and hold through volatility, and be able to do well over time through buying cheap when things are hated, and being able to hold when there are powerful but faulty narratives that are perpetuated.
Yeah, absolutely. That fundamental thesis being the North Star. And it's crazy the noise you mentioned. The oil price hasn't been terrible for investors over the last 18 to 24 months. And when you consider everything that's been thrown at it, SBR release, all these things, and we've surely we're running out of bullets in the chamber in terms of like delaying the thesis, like those ducks, the drill but uncompleted wells. Like surely we're starting to get to the bottom of the barrel there, and 100 rigs on by the end of the year, from your lips to God's ears, Josh, for all of us and the I guess the drillers. We're hoping that that happens. It's a perfect segue into this next segment when people on Twitter, they always have this kind of joke line about stock price when moon. I'm looking at the uranium folks there. For me, it's about CAPEX when flow. When is the CAPEX going to come down the chain? Do you see, how do you see the value proposition between, say, the services and the producers? And we'll pick it up from there, and then we'll start to talk about some of the small cap producers that I know that you like.
Yeah, I think it's a great question. I think services still sort of don't get their fair shake. And the way we approach things at Bison is through trying to find businesses at a large discount to their intrinsic value. And one of the sort of classic ways of determining intrinsic value is replacement cost along with long-term earnings power. So if something costs a lot to replace, but it's never going to make any money, because it's broken and you just can't fix it, or it's overwhelmingly expensive to fix it, to use it, replacement cost isn't so great. But when you look at things that have enduring value, like a pipeline or a plane. I mean, I know it sounds weird because planes depreciate, but there are 50-year-old planes that are flying right now. You look at various sorts of physical items or infrastructure or so on. There can actually be some pretty impressive enduring value in equipment. And so when you look at the replacement costs, and also sort of in like service lines where maybe it's not exactly the physical equipment, but the ability to deliver, let's say, chemicals or certain other things, a value chain can have sort of that replacement cost aspect and can have a real, it could trying to replicate the ability to deliver, let's say, sand from a sand mine and building that sand mine to an end user to frack a well or so on. There's a lot of different components there that can be quite expensive and time consuming to replace as well. So we look a lot at replacement cost. It's very complicated to go through this on producers, and we tend to not show our work too much on that just because it's just it's sort of a mess and requires a lot of different inputs on a lot of work and a lot of engineering work and so on. On the services side, it's actually sort of a little easier, where you can take a rig company, for example, and you can get estimates from them of what it's going to take to rebuild their fleet, for example, or to refurbish available equipment that they could buy and then fix to come up to a replacement cost for their current fleet. And there are many companies trading at half or less of their estimate of replacement cost. And where we've chased this down, companies have actually been, historically, they were not always so great as sources for estimates of value. But on the services side, it seems like they've been blown out so much that for the most part, in the last couple of years where we've gotten replacement cost estimates, they've ended up being, let's say, 10 or 20% or something off from what we've been able to sort of independently validate. And so getting to buy companies at large discounts to the replacement cost that are also generating a lot of free cash flow and a lot of earnings. It's this sort of bizarre moment that's so very rare. And it's what gives me such confidence in owning both the services names like this. They're typically smaller cap. They're typically off the run. You won't see people talking about them too much. Again, deep value is really not, it's rarely popular, but it's very unpopular in the current sort of AI boom and XYZ fad stock and meme coin and whatever, right? It's very unsexy. This sort of work on replacement costs and so on. I mean, it's really, it's a lot of work. And like, what's the reward if you figure out that a company's at a third of replacement costs, you buy the stock and it goes down 20%? I mean, it's
The story of my career. Yeah.
yeah, and then it goes up 1,000%, and people say, "Oh, you're lucky," and "Oh, your sector was up 100%, so of course, whatever." And you have to like not care about any of that in terms of what they say, but it is the market dynamic, and it's important to understand that. So it's so very rare historically to find companies that are at a large discount to the replacement cost, that are also generating substantial cash flow from their businesses at the same time. It just doesn't, you get one or the other. That's sort of the general value thing. And the saying is on services that you buy at a discount to book value and you sell on earnings. But it's hard to sell on earnings if you can still buy at like a third of book value. And book value is not perfect. I'd be very careful with it because, you know, some companies did big write-downs or had bankruptcies or other stuff. And so, you know, looking at their book values, there's adjustments in both directions that are necessary. But it's just such a weird, promising. I think there was a brief moment in roughly 2002 where you could buy oil services names in a similar sort of setup, and you know the oil services stocks went up 400 or 500% or something. The sector did, so the small ones went up way more than that in that cycle, and then you have to go back to, I think it was the early 70s. There was also a brief moment where you could do this. It might have even been like 1969. Like by the time you saw oil prices really start to move, oil services stocks went nuts. It was the Munger, and I think Munger made, I think the money he put into Berkshire in the 70s, he made from buying an oil field services stock in the 60s that had these characteristics. It's just so rare. No one talks about this, right? These guys, they were oil investors and then they went into insurance. And Buffett less so, but Munger, and then they had a third partner that helped him get control of Berkshire, and he ended up using margin and getting blown out, I think, in the 70s. And I'm sure there's going to be Buffett fans that are going to say, "Oh, you don't remember the guy's name," and it's okay. Like, just don't use margin. You won't be like him. Don't, you know. So anyway, I think it's a really promising time to buy small cap upstream and services names because they hit sort of both ends of the value spectrum. You can get great discounts to replacement cost, really sort of interesting, tangible book stories, and earnings and growth and promising improvements on cost structures and other things. I mean, it's just, it shouldn't happen. It shouldn't be available. So it's really exciting. And you know, it's also challenging as a portfolio manager. There's things I love that I'm selling to go buy more of this stuff that people think I'm crazy to own. And it looks like the stuff that Munger got a 50x on or whatever and used to be able to get into Berkshire. So
Yeah, it's such a strange kind of holy trinity moment. It's a discount to the tangible, but it's earning cash and it's got the ability to grow said earnings. I want to touch on something that you really helped me change my perspective on, which I guess a lot of people generally look at large caps and big companies and say, oh, they're going to do well because they've got the ability to perform economies of scale and they can reduce the unit costs and blah, blah, blah. And you very politely corrected me in terms of saying, well, in this type of environment, small caps actually should trade at a premium because they have the ability to compound at greater rates. And you've got a base effect from starting at a very low market cap or acquisition cost. One small cap that I know you like is Vital Energy. Do you still like the company? And then I wonder if you could talk me through how you see Vital through the lens of the factors we mentioned. So its replacement cost or tangible value, perhaps, an estimate of its cash flows, and its ability to potentially grow those in the future using AI.
okay, so we'll start with AI first. So Vital, I sort of I thought I'd just see sort of social media is wonderful for sentiment among other measures. It's also terrible and can sort of drive people crazy. And I've seen people ruin their sort of investment processes and stuff by using it. So I would, you know, be very cautious with it because it's not designed to help people. It's designed to sucker you in and you know, have you buy whatever's being advertised. So it's a you know, I think it's general, but as a you know, informed user trying to be careful and specific with the use, one thing it's been really helpful for is measuring sentiment. And so as AI was picking up sort of steam last year, I started to see companies talk about it that weren't, you know, Nvidia or Microsoft or whatever. They weren't, you know, investors in ChatGPT. They weren't providing the chips. They were XYZ. You know, it was sort of like the what was that? The Long Island iced tea company that turned into Long Island blockchain, and the stock went crazy. So, and there were stocks that were doing that. on the AI side. And so I said, hey, I noticed AI, Vital is starting to use AI, and they actually have like positive results from it in terms of AI is not sexy in oil companies. It's used to cut operating costs and improve operating efficiencies. So, but it's real. And so I figured, hey, I'll talk about this and just see what people say. And so, of course, or I don't know if I should say, of course, it was amazing to me how much people overcame their love for AI to channel their absolute hatred for small cap publicly traded oil and gas companies. Absolute hatred. It was incredible because unlike most of these companies that actually got enormous valuation boosts and so on in their market caps and whatever from just saying the word AI a bunch of times in their conference calls, these guys actually had measurable financial improvements from using AI to lower their operating costs and improve their operating efficiencies. Their wells are online more, and they cost a little less to run, and they have to send fewer people out to fix them. I mean, just sort of very basic things. If you think about it, like, if they have 1,000 wells that are running and, they're able to remote track all of them, instead of just by default sending, if you think about wells as like bathrooms, you need a plumber to go to do whatever for your bathroom, right? So do you have a plumber come by your rental units every month, or do you have your tenants when there's an issue call up and but if there's no tenant, if it's just a thing, you need a remote indicator that's equivalent of your tenant saying, hey, there's a bathroom problem, send the plumber. And then if you are able to collect enough data, you can actually forecast when there's going to be blockages or so on and send people proactively to get the uptime even higher. And by proactively doing it and scheduling it, you can have fewer plumbers, or the same number of plumbers, but addressing more issues and have more uptime. And if you are doing preventative work rather than after the fact repair work, it can cost a fraction as much once you're actually doing the thing. So, an ounce of prevention is worth a pound of repair or whatever. So, it's a very sort of simple concept. And other oil companies have done it, but they hadn't really provided, like BP had they called it crystal ball software years ago that they were using for this sort of thing. But there were limitations to how they were implementing it. And AI really helps because you need to learn a lot about the stuff that you're doing. You can't really use off-the-shelf software for this because there's lots of different, there's a lot of complexity, let's say. It's a very chaotic, complex system. It's why people, I think, are so reluctant to attribute value or to think that an oil company could use it because it's just so complicated. But the complexity makes it actually a really good use case for AI. So anyway, it was so amazing how much people hated this, even though there were actual financial benefits and it's logical, right? You can just think about it and say, okay, well, if you have 1,000 of these things and they need to send out all these expensive people, and if they can forecast when things break and they can fix them before they break, then they can do a cheaper thing instead of expensive thing. I mean, it's like really not that complicated. And, they very helpfully have multiple pages in their presentation talking about it, and they cite software which people can go hunt down and see that other companies are using it too. So anyway, very interesting sort of non-financial, non-valuation moment where you get to see, wow, people really hate this, and they hate it despite a positive move. Like there's no way it cost Vital even a fraction of what they're saving and making because they're implementing this, right? The ROI is enormous. They don't show it exactly, but it's got to be like 10x or 50x or somewhere in that sort of order of magnitude. And for people to be negative about it, it's like, I don't know. I mean, it's very, that's an aspect. It's one of these sort of non-financial signals that I think is very, very promising. So I just wanted to focus on that first, because it's just so people think these things are, to attempt to like sucker in investors or get a higher valuation. These guys actually are among the few companies to actually show positive improvements, not on the software side, not on the hardware side, but on the actual end user side. And again, it's one of those things where the reporters at these various publications, if they hated oil and gas less, they could actually report on this. Like there are AI beneficiaries, right? Where are the AI beneficiaries in the world? Here, right? It's a great story, and you don't hear it at all. Instead, you hear people mocking it because, oh, this company couldn't possibly, and I shared this one other thing on social media. I know it's a lot, but I shared this one story. So I was chairman of the board of a small publicly traded company in Canada for under 2 years. And I came in, the CEO had a heart attack, and it was a sort of a messy situation after the oil price crash in 2014. The board was fighting with each other. I came in, I was one of the largest shareholders, got control of the board, reshaped the board, we sold off assets, and then sold the company. And as a part of that cleanup process, we were losing money on our natural gas. And so I started went to like Spring, Texas, and bought some used Bitcoin miners that were cheap because the price of Bitcoin had started to fall in beginning of 2018, and started sending these used Bitcoin miners up to the well site to just, we had power generators to burn some gas. And some research analysts came out and said, oh, if there's any sort of gain for this, clearly Iron Bridge can't be the one that would benefit. Other bigger, better companies would benefit. It's like, well, sure, except they're not doing it. Here we're doing it, and it worked. And we got bought out before we were able to really scale it, and Bitcoin prices collapsed further. It's a good sort of cautionary tale on some of these companies that are doing that sort of thing now, relying on a very volatile commodity that doesn't have any real, it's not oil where it's consumed. But the point is that people, when they hate something so much that they'll irrationally attribute negativity to high ROI, highly economic activities. I don't know. I mean, that's like, you can ignore valuation to some extent. I mean, that's just, and again, I'm very value focused, but that's just such a great indicator. It's an all clear to go buy a lot of a stock for me, because that it's such a good idea for them to do it. It's great they're doing it. Are they the best company for it? I don't know. Do they have the most benefits from it? I'm not sure, but they're doing it. They're showing positive benefits from it. There's no news articles about it. And or very, very limited coverage relative to coverage of AI and supposed benefits that aren't tangible, that no one really shows. So anyway, just very promising and interesting. And I think the negativity around that makes it very, we'll get into the financials, but that's just such a good sign from my perspective for something. So yes, I like it. I probably like it more now than I did then, partly just after seeing this, leadership and derision, and just seeing sort of how it paralleled with this other experience I had directly, and what a great idea it was in 2018 to go buy Bitcoin miners and stick them on well sites where you had power gen and you were losing money on your gas.
Absolutely. Yeah, I know it's a great sign of the hatred towards this sector. And my Uncle Rick Rule says he loves hate. There's nothing more he loves more than hate. And I think that plumber analogy was very helpful, at least for me, to really put it into perspective in terms of this is not some airy-fairy, ethereal expectation of the future. These guys are doing it real time right now and producing tangible operating efficiencies to produce tangible results for company shareholders. So I think that is, we're getting the word out. If no one else is covering it, at least we're doing God's work for now. Let's talk about some more tangibles. What's the infrastructure like of this company? How do you view its current enterprise value or market cap compared to its tangible assets? And then we'll talk about its ability to grow and perhaps a pathway to a successful investment exit sometime in the future.
Sure. So without getting into too much of the sort of, there's a complicated analysis of replacement costs, which would be going through and saying, okay, how much would it cost to drill each of these wells and then produce them down to where they're at right now, to be able to, to buy the land, drill the wells, get the midstream deal set up, get it all to look identical. So that's a long thing, and I don't think it's really going to help people to go through that analysis.
A back of the envelope version might look like.
Right. So the two easy ways to do it are, one, what's the proved reserve value, which again was one of these amazing narratives that, oh, small oil companies have smaller reserves than large oil companies, which is true, but they also, the part that's not true is on a per share debt adjusted basis, many small oil companies have much larger reserves than larger oil companies. So Vital's an example of that, where Vital, in their year-end report, going just off memory, they had about $5 billion in proved reserves, most of which was proved developed, versus an enterprise value at the time we're speaking of, it looks like around $3.5 billion. And so they're at a pretty large discount. The stock would have to roughly double. The market cap's a little under $2 billion. The stock would have to roughly double to trade up just to the proved reserve value, which doesn't include hundreds of drilling locations that they're not going to, anything that's not going to get drilled in the first 5 years doesn't get included in that proved reserve value.
Now, is that proved reserve value, are we talking 1p or 2p? So is it developing or it's with the
Proved
2p?
is 1p.
1p,
And so
wow.
most of it's
Wow.
on the proved developed. So it's the already drilled, already producing portion. And then a smaller portion is the proved undeveloped, but that still falls in that 1p category. The 2p category would be higher. I don't know that they've disclosed it. It's more of a Canadian or international thing. The US companies often don't disclose their 2p values for a variety of reasons. Many will only disclose the standardized measure of cash flows after tax, which is the required amount that the SEC sort of requires that you show a reserve report. And at least it used to be they'd require that standardized measure, and that was it. And so many companies would just sort of meet their disclosure requirement. I think those rules have changed in the last few years, and so you'll end up seeing different disclosures. But that's sort of the most common to find is that sort of 1p value and or the standardized measures. One thing people talk about very little on Vital is their enormous tax shield. So in an environment of higher commodity prices, people start to do the work on the after-tax value. And because of their large tax shield, their after-tax value is actually pretty close to their before-tax value on a discounted basis. So I think it's worth noting and very different from some of their peers, which are cash taxpayers and could make Vital an extra compelling buyout opportunity for taxable companies. So the one other easy sort of heuristic is what's the liquidation value. And so there's a reserve value, which again is helpful. It's not perfect. You want to check out the reserve auditor. You want to check out the trajectory of it historically, as well as any reserves on stuff that was acquired. And you want to sanity check those. They're not perfect. Reserve reports are provided in private transactions by sellers. Typically, a buyer will do their own. So if you're an investor in a public company, you want to behave like a buyer and not just treat the seller's reserve report as if it was, definitely true. It's sort of like a real estate assessment, or what do you call it? You get people appraisal. It's good, but it's not perfect. But in Vital's case, from what I can tell, it actually looks pretty reasonable. And we checked out some of those characteristics and have a different view on their reserve value, which actually might be slightly higher. But it's good. It's sort of weird. They were good about sandbagging it. The other way to look at it is transaction value. So looking at similar assets and similar companies selling. This is part of why we've shown those transaction values. And people get so mad about this too, which is also sort of promising. On the buyer side, at least among the engineers and the sort of acquisitions managers, the CEOs, I think, care a little about prestige and like the name brand of the company they're buying. But if Vital was a private company, if it wasn't publicly held and they wanted to sell, they would already have sold for over $100 a share. Like there's no real question, as far as I can tell, among people I've talked to who actually transact in these sorts of assets. The assets are outperforming their expectations. They repeatedly have sort of beaten and raised their production guidance. They've added hundreds of locations organically from the stuff they've acquired, as well as their base business, which is important for reserves. But they show it in their presentation basically through delineation and offset results by competitors. There's basically more zones in their assets than they had claimed or than they underwrote, and they can actually drill more wells in the previously identified zones to get even more oil than people had thought. So their organic reserve replacement was phenomenal this year, and it's probably going to be even better next year. And they're doing really well. That performance matters a lot in a transaction. It's not just about how much production is there. It's also what's the capital efficiency, how much inventory is left, how much undelineated inventory is there. And I think they've shown really good progress on that. And so when you look at those measures and you look at historical transactions and recent transactions, there's a minimum uplift, it looks like, of 80% or so relative to where they're trading. And I say that while like sort of laughing because it's so ridiculous, but some of these recent transactions on offset locations, right? In many cases, these are wells that are almost identical. You can throw a stone from where that transaction happened to a Vital well. imply 3 or 4 times upside relative to where Vital's trading, which is only sort of 2.5 times upside to their enterprise value, if you keep in mind that they have about 50-50 debt and equity, or I guess these days it's sort of 60-40 equity to debt. But there's still a lot of financial leverage, which offers a lot of sort of potential upside. So those are both ways. And again, lots of work involved, even in sort of vetting those two sort of simple heuristic type things. But if you just use the base numbers, there is a clear, dramatic mispricing. There's reasons for the mispricing, but I think those are reasons that sort of get absorbed through good operations and through time. And I think we're sort of in this weird period where people hate it so much, and from some of the things that have happened in terms of creating this asset base and getting the company to where it is, that the market's providing this sort of unique opportunity to get this thing that's worth a lot more for a lot less than you'd have to pay if you bought it in the private market, and a lot less than what it would cost if you tried to recreate it.
Yeah, I think you addressed those factors really well. So we've got a discount to the replacement. We've got improved efficiencies leading to an increase in both earnings and potentially margins. I want to squeeze in two more considerations before we wrap up. The potential for a multiple expansion, that would be like my absolute dream with this company. What would it take for multiples to expand in these types of companies? And then we'll finish up with potential nightmare scenario of being bought out for maybe a 20 or 30% premium, and whether you think that's likely or not in this case.
So I'll address the second one, which is that I can't make any guarantees, but I would expect that there would be a number of shareholders that would be averse to that sort of buyout outcome that was at a large discount to recent transactions. And I think management is probably aware of that. But also, when you look at management's financial incentives, people behave according to their incentives, and they make a lot more money if they sell the company for $100 a share than if they sell it for $50 a share. And there's this idea around the company that they wouldn't sell for $100 a share because they like their jobs or their paychecks, but they're not bad at math. They're also not bad at operations, as you can see from these improvements, and they're pretty innovative. They don't seem to be bad at math, and the math shows that they make twice as much money if they sell at 100 versus if they sell at 50. And per their numbers, they're on track to generate about 20% of their enterprise value in free cash flow at today's commodity prices, net of the effect of their hedges on natural gas. And natural gas, the hub, Waha's negative, so they're very well hedged on gas, and they're somewhat hedged on oil. And so net of all of that, they're on track to generate sort of a 20% free cash flow yield here, which they expect to use mostly to pay off debt initially. But then they did have a buyback in place a couple of years ago that they deferred in order to go buy more assets and grow in the way they've been able to grow. But I think it would not be unreasonable, given their incentives, to see them go slow down. They've already sort of communicated they're more interested in doing, they're calling it Moneyball acquisitions, like small deals at high valuations. Their last two, so 3 deals ago, I didn't like that. It was pretty dilutive and big, and their share count's up a lot. I did not like that. But the last 2 deals have been smaller and fantastic. They bought stuff using stock at 2 times free cash flow. I will fully endorse any of my companies going and doing something if they're trading at a 20% free cash flow yield and they want to go buy more stuff that they already own. Right, it was adding additional assets where they'd already delineated additional inventory, and using equity, they didn't have to pay for any of that extra inventory, and they did those transactions at a 50% free cash flow yield. Huge improvement, and they're signaling, again, you can't count on them not doing another bad deal, which is a risk, and one reason I think the stock is trading lower. And it's important to understand that in terms of what may happen next. I think they might understand that based on what they've done as well as their messaging. And if they keep doing that, right, only buying stuff that's super accretive day one, and then take the rest of their money and go and pay off debt and start buying back stock, I think there's room for them to quite quickly change from trading at a large discount to their competitors of a similar size and type and capital efficiency and so on, to a premium, or at least in line with their competitors, and from a large discount to recent transactions to in line at least with the low end of those transactions, which again would be sort of in that like 80 or 90 or so dollar range per share price.
Yeah, it would be so heartbreaking to get the thesis right and then come in for, you know, just a 20 or 30% buyout would be, it would break my heart.
It wouldn't be the first time that's happened. We've had some success in fighting stuff and some failures. And you know, I think in this case, just there's so much money on the line for these guys that I'd like to think that they're not going to do it. And then I guess that my mention on their transactions was sort of a tangent. They seem to get it, and they seem to be generating a lot of free cash flow right now. And so there's not really, if you can make, let's say, $50 million instead of making 25 or whatever, through getting your stock to 100 instead of selling the company for 50, right? And again, not that they would sell for 50, but let's say they were going to sell for 60, so maybe it's 30 instead of $50 million. You can make $50 million by taking the company's extra cash flow and 50-50 paying off debt and buying back stock for like 2 years. I mean, what are you going to do with the money that you get the 25 instead of the 50? That's going to be as certain as just taking the cash and buying back stock at a discount to comps, at a discount to liquidation value, while your operations are performing really nicely. So I think there's sort of a very easy, obvious setup. And again, I've been wrong on these things before. It could happen that they could end up taking money, whatever, right? Maybe there's some other reason to do it. There's some whatever. It's happened before. It will happen again. But I think in this case, the executive comp plan on a takeout is generous enough that there's a really significant incentive for them to get taken out at premium. And then getting to the multiple, which was that other question. So I think people really didn't like that deal they did. And then there's a lot of overhang on the stock from private equity funds that own a big portion of the company. There's also over a 30% short interest relative to the float, which is likely some of those private equity funds having shorted the stock to essentially pre-bake their exit. So I think it actually makes that overhang a lot less bad. I think a lot of the pain from it has already been experienced, even though they haven't all gotten out of the stock. And so there's a risk that one day we wake up and the stock's $5 lower from there being a secondary offering of some of these shareholders getting out. I don't know what day that is. And the reality is that the sector's up so much versus the stock. There's been a widening multiple gap, which frankly the private equity funds know too, and I think would have an incentive to sort of wait to get a little bit of a better multiple. And I think the longer it takes, the more it's sort of like a coil that's sort of pressured, the more pressure there is on it, and the more potential there is for that sort of re-rating higher. And then also the more likely it is that you have one of the large long-only funds that owns some of the stock either through one of their ETFs or just as a part of their ownership of the sector, coming in and buying out 10% of the company from XYZ private equity fund in a private off-market deal that doesn't even go through a secondary offering or so on. So I think it's set up really nicely. Why it's cheap, which is nice because they did this one deal that wasn't great. And that was about a year and a half after drilling 3 wells that weren't great. And in the interim, they've done a number of deals that were good, and they've drilled many, many wells that have been great, and they keep beating and raising in terms of their financial and operating results. And so I think they're 8 quarters into beating and raising in terms of, producing more than expected and actually making a little more money than expected. And historically, when you look at companies that start at low valuations, by 8 quarters in, you're at a big premium instead of a big discount. And again, the deals sort of threw that off. But our initial thesis in terms of like why we shared our thesis when we did was they had dramatically improved their operations, and that's continued. And we were negatively surprised by one deal that was large and dilutive. And both before and after that deal, the other deals they've done have been accretive. And then they found a large amount of resource on the assets they bought in the deal that looked dilutive. And they've also beaten and raised twice since then. So it may be that maybe we didn't have to hate that deal so much. And maybe the market can stop punishing them for it at some point if they find 200 extra drilling locations, of a quality where those are transacting for $3 or $4 million per location in other transactions, and they only paid $1 billion for the stuff, and they got 30,000 barrels a day of oil, which is worth, or oil and gas, which is worth what they paid for it. So maybe they got such a great deal on it that maybe they'll get forgiven for it. So again, I don't know, maybe they won't, but it's set up really nicely where the operations, they really improved them, and they're innovative on this AI operations improvement, but they're also just drilling good wells in good areas and adding to their inventory. And so, I think operationally, they're set up like if you didn't know what company it was and you normalize the numbers, you would think this would be a company that traded at a large premium valuation, not a large discount. And then if you looked at just their last couple of deals, you would think this is also a company that would trade at a large premium, not a large discount. And when you combine them and look at the very many deals in their area and the huge premiums for these large deals in their area relative to where they trade, it's a thing, it's a large position for us. We really like it. We added to it on the pullback after their last deal. People really hated it and sold it off pretty hard. And, I don't know, it's possible that it just lags, or they do a bad deal, or they have some well issue, or oil prices fall. There's always risks, but I think the asymmetry here is substantially to the upside. And there's just so many measures where they just show this thing being worth, 2 or 3 or something times where the stock is trading, that, it's pretty comfortable holding it even with those risks, and where you could just wake up one day and it's at 80 instead of 50, and it just wouldn't even screen that different. It'd just be closer to the comps in terms of free cash flow yield, and they'd be trading around their proved reserve value, which is sort of normal for their comps and so on. So anyway, it's a pretty easy one to talk about, and it's just one of those things where if you're not sure, you just look at all the negative things people have to say about it, and then look at the financial results and say, well, do I believe XYZ person who's like cat was run over, or do I believe their GAAP accounting with good auditors, and look at their shareholder list and look at sort of what they've actually done over a multi-year period. And I think the one other thing I'll share, and I was thinking about how to frame this, but if you look at this one deal they did, and you look at these few wells that they drilled that weren't that good in, what was it, 2021, I think you can get this idea that, these guys are really sort of foolish and they're not competent operators and so on. But when you zoom out and you look at this team has been in place since roughly 2019. They termed out their debt in 2020, right before COVID. So they were able to survive, and they were very hedged. So they were very careful in terms of that. And they cut their capital program aggressively, even though they were hedged. So they were very well behaved, unlike some of the gas producers now and so on. They were very careful coming out of COVID. They didn't drill through all their inventory. They acquired a giant amount of land and drilling inventory from 2019 at an average cost that was actually pretty reasonable, on a per acre basis, on a per drilling inventory, like per location basis. They've added a lot of locations from what they've bought